Thank you, Iman, for coming.
My pleasure, thank you.
So my co-anchor was talking about the numbers, today's numbers, job numbers. She said, were they disappointing to you because we were expecting higher numbers? According to Bloomberg Economists, we were expecting 180.
Right.
Wall Street Journal was expecting 185,000, I think. Was it a disappointing number? How do you comment on these numbers?
It's never easy to forecast non-farm payrolls, and especially in this case, given the fact that we saw that low print for the previous month that was largely based on weather, according to a lot of analysts' estimates. So I personally try not to put a lot of weight into each individual non-farm payrolls release. Easier said than done, obviously.
You look at the bigger picture then?
Yeah, absolutely. I mean, I think the long-term trend in U.S. In the job market in the U.S. is still positive, even over the past couple of months. I think there's been a little bit of a curveball there. There's a little bit of weakness, but I think you have to still take mostly a positive kind of impression from the direction of the U.S. economy, and that includes the labor market.
That's true. And I was looking at the figures, the indexes. They were recovering after the drop on jobs report, the unemployment, not much about the non-farm payroll, but they're looking at 6.7% and going down to 6.6. And,
yes.
You know, Fed's targets, they are going to be, they were all talking, all the Fed heads were talking, they were saying that maybe we should even increase the speed of tapering before we reach below 6.5. Do you think we're going to reach there?
Like I said, I myself, because I don't forecast U.S. economic outcomes, I have to kind of look at this from my perspective as an EM guy. And my perspective is that we shouldn't be too alarmed when we reach that 6.5% target that the Fed has set. We could reach it very soon. We could reach it as early as next month. I'm sure there's a possibility of that. The Fed has been very clear from my perspective that just because we reach that 6.5% target, which is a threshold and not a kind of automatic release valve, if you will, for an end of tapering or putting us into a territory where we could hike the federal funds rate, we could go well past 6.5% according to the Fed before we embark on some more serious tightening of monetary policy. So I'm not concerned too much.
I'm glad you also mentioned that you're looking for an EM perspective.
Yeah.
So what happened there? Why are we in this mess with the EM, emerging markets? What's going on? I want to hear your opinion.
Yeah, well, everybody has an opinion on this. But mine is that, in 2013, obviously, the big trigger for the sell-off in EM, as we all know, was the beginning of the discussion about a tapering of quantitative easing that happened in May of last year. I think early 2014, what we started to see was people started to move from concerns about the long end of the U.S. curve. We saw higher rates at the long end of the curve hit EM in 2013, but then 2014, we started to get a little bit more concerned about the credibility of the Fed's forward guidance. So you started to see the front end of the curve start to move up. So this kind of put some additional pressure on EM because rates all over the U.S. curve were supposedly at risk. The thing I think that's really hurting EM right now is growth, global growth. And the reason I say that is because there was a kind of weird correlation that we saw in 2013 where good U.S. data would be released, rates in the U.S. would rise as a result of that, and then EM would take a big hit, which was really in relation to that higher U.S. rate story. Now I think we're getting into a little bit more of a normal scenario where low growth in the world, whether it be in the U.S., China, Europe, whatever, hurts risky assets across the board, even as they lower U.S. rates. So I think it's kind of a mix of the U.S. monetary policy story, and now we have this new kind of monkey wrench thrown into the whole thing, which is global growth.
I like the way you said that, monkey wrench. And then the sell-off change, you also mentioned that about our long-term view. Should we be really concerned about it as an asset class and also all the risks?
I am not one of those people that thinks that just because we've seen this turbulence in EM over the past year, that it means that the long-term fundamentals of the asset class have been impaired. I still think there's a lot to look forward to in EM. I won't regurgitate what a lot of people are talking about in the media, but there's the argument about debt to GDP, which is much more attractive in EM than it is in DM. You have the argument about external debt to GDP, which has declined for most EM countries over the past decade or so. Those things are kind of well digested. People kind of are familiar with those arguments. The thing that I really look at in EM that gives me some confidence going forward is First of all, you have this convergence between developing countries and developed countries. We all are familiar with that concept, and I don't think that's a long-term phenomenon that's going to be disturbed just by the fact that we have this volatility around the Fed and around global growth concerns and things like that, things pertaining to 2013, 2014. In the long run, I still expect the emerging market individual to converge in terms of his incomes to the developed world. And the other thing is, perhaps more relevant to markets, I really think the quality of policymaking in EM is much better than it used to be. Now, there are some exceptions, right? We know there are countries with policies that the market has been quick to attack or quick to express its frustration over. But I think the bulk of countries in the EM space have really improved their quality of monetary policy, even fiscal policy, over the past few years, and that's what's giving me a lot of confidence going forward.
So these are your reasons for positive outlook, but what do we need for the spark again, for this EM to turn around and show us a rally again?
That's the $10 million question, or whatever you want to call it. I mean, everybody's asking that question. What can be the spark that really turns EM around? I would say there's two kind of broad things that I've been looking at. One is, could it be possible that a major central bank in EM would give us some sort of impetus? We saw that in 2011 with the ECB. We saw it again in 2012 with the ECB and the Fed. I'm talking about kind of LTROs, which picked us up from the 2011 sell-off. And then, as you remember, Draghi and the "we'll do whatever it takes" concept, which became the OMT, saved us from another round of concern about Europe. This time around, is it possible that the Fed or the ECB or the BOJ or the PBOC would come in with some new liquidity that would cause us to get a little bit concerned about the Fed withdrawing liquidity? I'm not so sure. I was really hoping that yesterday Draghi in the ECB press conference would say something that would suggest that the ECB is very worried about deflation, but really listening to his words, he didn't seem that concerned about deflation. So that kind of took a little bit of that possibility off the table. I think if you're looking for something to really rescue EM, it's not going to be something sudden, unfortunately. It's probably not going to be some sudden announcement. It really has to be a turnaround in the pace of global growth.
We'll see. And wait, we have to go right now, but I have so many more questions to ask you. I have to have you back. Thank you, Eamon, for coming.
My pleasure.